Welcome to the 2017 fourth quarter investment call with the San Diego Foundation. Thank you for joining us today. Quarterly investment calls are an enhanced service to donors. The calls provide direct access to our investment leaders in a consistent, convenient, concise format so donors can remain informed about the performance of their charitable assets. Leading today's discussion will be Horacio Valeiras and Matt Fettig. Horacio Valeiras is the president and a principal at HAV Capital, LLC, and serves as investment chair for the San Diego Foundation Board of Governors. Horacio has more than 24 years of investment management experience, is the portfolio manager for the HAV International Growth Strategy, and oversees all investment and trading functions. As Chief Investment Officer for the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to foundation investments. Today, Horacio and Matt will start the call with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio, our long-term, medium-term, and short-term portfolios. We will conclude with a 10-minute question and answer session. To submit questions for the Q&A session, please use the questions chat function anytime throughout the call. Any questions unanswered during the call today will be answered via email. Attendees can access slides and a recording of today's call on our website at sdfoundation.org next week. Now, Horacio Valeiras will get us started.
Hey everybody, this is Matt. I'm actually going to start here and talk about performance first and give you a sense of how we did for the year. So you can see here the first exhibit we're looking at is our returns through December 31st, 2016. And I'll draw your attention to both the fourth quarter. We were up 1.3% for the endowment portfolio, and for the 1 year, up 8.5%. We're pretty happy with these numbers. In fact, if you look at our 1 year number and compare it to other like-minded endowments and foundations of a similar size, we're ranking in the 6th percentile, 1 being best, 100 being worst. So from that perspective, overall a good year, following a 2015 that was not as good. But when you look at our longer term numbers here, a few things I want to point out. Over the 3-year period, we're coming off of what was an earnings recession, a bear market in energy, a strong dollar, and as a result, in prior years, performance had been roughly flat. So we're seeing a recovery here, and we'll talk about that more in the macro section of the presentation. If you look at the drivers of performance for, and I'm going to focus on the 1 year period, given that we are at the end of a calendar year, U.S. equities continued to be a strong performer, particularly small cap equities in the U.S. That was the best performing sector of the portfolio for the year. We had a bit of a reversal from the previous year where we saw a good amount of strength out of the emerging markets. And I think as we've talked about before, this portfolio is relatively overweight the emerging markets, and so strong performance out of that segment was certainly welcome. I also want to highlight our fixed income portfolio. As many of you know, following the election of Donald Trump, we had a large backup in interest rates. And a lot of us were waiting for this backup in interest rates for years to occur. Typically when rates go up, bonds prices go down. But we were fortunate that we had one standout manager within our fixed income portfolio that allowed us not only to sustain the rise in interest rates in the fourth quarter, but to produce a positive rate of return when almost all bond portfolios were down. So from that perspective, strong performance. And then if you look at our alternatives like real estate, like hedge funds, like private equity, we also had strong results. And then finally, I just call out our position in the commodity space, which, as many of you know, we had a pretty dramatic decline in commodities. That area snapped back last year, and we were seeing strong positive performance out of that space. So just moving on here, this is the long-term portfolio. Remember, we invest this portfolio much like the endowment, but we exclude all illiquid positions. So this is a liquid portfolio. And many of the themes that we just talked about for the endowment were the same. We had good performance out of our equities. We had an overweight position in emerging market equities that helped us. And we had fairly strong performance out of our fixed income managers as well. Here, our alternative investments tend to be liquid alternative investments. And we saw one particular manager have a pretty good turnaround from where they were positioned the previous year, which certainly benefited the portfolio. And then here is our medium-term portfolio, invested a bit differently than our long-term portfolio and our endowment, in that this portfolio is heavy in fixed income. It's a more medium-term portfolio designed for more volatility mitigation. And as a result, you can see here that it was flat for the quarter, but up 6.2% for the one-year period, ahead of our expectations for this type of portfolio, particularly in this environment. It has 56% in domestic fixed income. Certainly, some of that positioning is at risk should we see a spike in interest rates. But within that segment of the portfolio, we have made sure to invest in managers that are conscious of the fact that interest rates may be increasing over a period of time. Equities, again, were the driver here, and the commodities position was certainly strong for us as well, given the recovery in commodities. Next page. So the next page shows the short-term portfolio, and I think it's worth highlighting here that this portfolio invests solely in money market funds. As most of you know, in a zero interest rate world, money market funds pay you next to zero. And for some time, many years now, this portfolio has been delivering basically a 0% rate of return. We've continued to offer it to our donors, knowing that some people want to take absolutely no principal risk with their philanthropic dollars, and we respect that. We've also encouraged those that would like to take some risk to shift pools given the environment that we're in. But we're now at a place where we've seen two increases in interest rates by the Federal Reserve, and we're starting to see some yield come back to this portfolio. Now you can see on a quarterly basis we're talking 0.1%, so it's not a lot.
Hey Matt.
Given Horacio, hi.
Hi. Just a quick question. That 0.1 just before is, it should be higher going forward because we're now at, what, 75 basis points?
Yeah, and I think it will be going forward, and that's my point is with another Federal Reserve interest rate increase in December, we should start to see more come out of this portfolio, which is encouraging. So those are my comments on the portfolio. I think we'll now go back and talk about the macroeconomic landscape, and I'll hand it over to Horacio.
Well, thank you all for joining us this afternoon. As you know, since November, it's actually been a pretty good time for the stock markets, particularly in the U.S., and not so great a time for the fixed income markets. And on the night of the election, the markets dropped a lot overnight, but then rebounded and proceeded to have a fairly significant rotation out of the stocks, more defensive stocks that have been performing well up to that point, into things like financials and energy and materials, on the expectation that we would get significant infrastructure spending, that we would get corporate tax reform, and that we would eventually get individual tax reform as well. This chart, which is the Russell 3000, so it's the broadest measure of the basically the largest 3,000 stocks in the U.S. You can see what happened. The last little pickup is from the election on. We've had a fairly good move, 6-7% in U.S. equities. We've had a smaller move in European and Asian equities, partly because of the strength of the dollar that resulted from the election result as well. If we look at the next chart, we'll see that. Can we go to the next? There we go. We'll see the earnings per share, which, you know, we all believe that over the long term, equity should perform in line with the earnings ability of companies, whether in the U.S. or outside the U.S. But what you can see, what we'd like you to focus on, the orange lines, which are the actual results, you can see that over the last basically 5 quarters, we've had what I'll call an earnings recession. While the economy has continued to grow, earnings for the S&P 500, which is a fairly broad index of the U.S. market, have dropped. We've seen declines quarter on quarter. That's the best way to look at it, by the way, rather than looking at it a year back. So second quarter against the second quarter a year ago, and third quarter against the third quarter a year ago. You can see that in the third quarter we started to see some growth in the orange lines. And in the fourth quarter, which we're now through about 71% of companies in the U.S. having reported their earnings for the fourth quarter, we're looking at about 5% growth across the market in earnings. Now that compares with a stronger increase in prices over that period, so that valuations have actually gone up. But the important thing here is that the earnings recession that seems to have ended. We're seeing sales growth of about 2% and earnings growth of about 5% for the fourth quarter. And analysts in these green bars reflect what analysts expect over the next 4 quarters. You'll see that they are expecting those earnings to continue to grow. If we turn to the next chart, we can look at the valuation for various markets around the world. So if you look at these bars from the left, price to book value, so that's basically the book value in the statements of the companies, price to earnings ratio, which is the most common used measure of valuation, price to cash earnings, which talks about the ability of a company to generate cash flow rather than earnings. A lot of times earnings can be manipulated, but cash flow is a truer measure of what a company truly is putting in the bank. We have the dividend yield for the markets, and then we have the earnings yield, which is the inverse of 1 over the price to earnings ratio. In other words, how many dollars of earnings are you getting for $1 of price that you're paying for companies? The blue bars are for the international markets, so basically everything except the U.S., basically everything except North America, and the emerging markets. So the green bars are for the United States, and then the orange bars are for the emerging markets. And what we'd like you to focus on here is that the valuation disparity that we've been talking about for the past few quarters remains. Basically, the U.S. Looks like it has the highest valuation across all these valuation measures. Europe and Asia come next. The developed markets of Europe and Asia come next, and then the emerging markets are the least expensive of all the markets, partly due to the fact that the U.S. has had the best consistent delivery of earnings for its companies compared to the others, and profit margins in the U.S. are significantly higher than in other places. So companies here, operating both here and abroad, but companies listed in the U.S. have been able to generate more earnings. Because of the higher valuations, the dividend yield on U.S. stocks is lower. We have seen a significant amount of share buybacks, but the dividend yield remains below the dividend yield of those two other markets. And I think this valuation measures support our view that we should maintain a diversified portfolio invested around the world, rather than, even though the U.S. market has been the best performer up to this point, rather than focus on the U.S. We can turn to the last chart. This is a slide that's got a lot of data on it, but we wanted to share it with you. It's put together by our consultant, Valeiras, who does a lot of the work on performance and on the funds and so on. And every year they put together an outlook of what they expect returns to be for many different asset classes. So you start with emerging markets on the left, you go all the way to cash on the right. And this is a 10-year forecast, and the dots are the midpoint, and then you have the quartiles after that, and for each of the different colors. So you have the 5th percentile to the 25th percentile, 25th to 50th, 50th to 75th, and so on. So if we just take emerging markets as the example, the midpoint forecast for 10-year returns is right around 9%, with a 90% confidence that it will be between -5 and 24. Now, I know that doesn't give you a lot of confidence in the tightness of the forecast, but basically what they're saying is if you look at history and you look at the volatility of the returns, these could come up in any of those places. The idea here is to try to figure out which asset classes are giving us the best return looking forward, and basically it's the opposite of what we talked about. The ones with the lowest valuation you would expect to have the highest returns. So you can see emerging markets and international developed markets having the highest expected returns. That would be the first bar on the left and the 6th bar from the left. And then the U.S. market giving you a lower return because of the higher valuations. So we do think that we should remain exposed to equities. We think, as I mentioned before, and we think that earnings are growing in the U.S. again. They're growing outside the U.S. Valuations are high, so it's something we want to keep in mind looking forward. So with that, let's turn it over to any questions.
Okay, we have one question that's come in here that I'll read. Will you be issuing one-pager summaries for the endowment and non-endowment funds as you have in the past? The answer to that is we will. We have everything posted on our website at this point. You're welcome to take a look. We have updated the same information that you've seen in this presentation as of December 31st on our website. And we also create a narrative piece, which we expect to be posting this week. And I just want to mention, if you do have any questions, you can submit them via the questions chat function, and feel free to type them in and we'll answer them. The next question, I'll hand this off to Horacio. What is the San Diego Foundation's opinion about the longevity of the ongoing bull market in stocks, particularly given the recent rally?
Okay, well, the first thing I'll say is that valuation alone never stopped the bull market. There's got to be some other whether it's earnings declining, economic recession, significantly higher interest rates, all those things can lead to stopping a bull market from its upward path. Having said that, I think a lot will depend on the policies of this new administration and what investors feel will be the impact of those policies on earnings. So let's take a couple of them. One would be corporate tax reform. If that were to happen and we would get corporate taxes down to a tax rate of 15%, I think that would be a positive. If we had corporate reform and the tax rate stayed in 25 to 30% range, I think the market would view that as a negative. Secondly is infrastructure spending. If we can get a deal on infrastructure spending, then certain parts of the market will benefit from that, and so we could see continued good performance out of materials companies, out of industrials, and out of financials. On the other hand, as we know, President Trump is meeting with the Canadian Prime Minister today, and he has talked to the Mexican president. If we were to get into a trade war and we would have protectionist policies, I think that would be fairly bad for the stock market. So the policies, the actual shape they take matter. And right now we just don't have enough information. We do know earnings are growing, and we know valuations are reasonably extended. So we take a cautious, optimistic approach towards stocks right now.
Okay, thank you, Horacio. Last question. If you were to have questions on how your fund was invested further, who should you follow up with at the San Diego Foundation? And the answer is your relationship manager. You can direct all questions through your relationship manager. They're always happy to bring me into the mix for a more detailed conversation, and I'm always happy to speak with all of you. So with that, I think that concludes our call.
Thank you for joining us today and for partnering with the San Diego Foundation to maximize the impact of your charitable giving. Today's presentation will be available by the end of the day tomorrow on our website at sdfoundation.org/investments. Have a wonderful day.